These three arrows on the S&P chart show exactly where CPI came out, and you can see that we're responding to that fairly well. The rejection of the 200-day is clear. The question is, can it be that obvious? Subscribe to this channel, click all notifications. What we go over is very timely and it's actionable. I do not waste your time with theory as much as actionable ideas and very specific indicators that you should be paying attention to, or very specific areas that can make you a better trade. I do appreciate all your comments. I do read them. Let's talk about what's going on here and why this is so troubling. So CPI, good. Another great CPI, and they just tap out. Sell, we get the POW, which is just a disaster of a day. But the gap down is troubling. When you have these gap downs and gap downs like this, it just means that we don't have any liquidity. And today for quad witching, the amount of problems that they had on the desk was staggering, but there's a little more than that. All of this data that came out, core CPI, see everything in red? All of this came in lower than expected. So core retail sales lower than expected, Philadelphia manufacturing lower than expected, retail sales lower than expected. And these are all 3-star major events. Core CPI, it's over and over again. And what's troubling is we're shaking off good news. Now, by good news, meaning inflation is starting to ebb. These are good readings. This is what we want to see. It's very clear what we have going on here, so we're going to have to watch this closely. There are some bright spots out there. The orange is the S&P. The green is value divided by growth. And you can see how value is just continuing to rise as we're seeing the S&P come down. And there's two pivotal things I want you to remember, and we're going to get into a little bit later. Stocks can go down, why value and growth continue to go up. The indexes can go down, why value and growth continue to go up. Those two concepts are very important. In other words, names like Tesla can easily implode down to 134, which it looks like it's heading to, or lower. Caveat, I am short this. Stay to the end because I'm going to walk you through exactly how we executed a trade in the trading community today. Here's Tesla breaking its 200-week moving average. This is the exact opposite of what you'd want to see if you were long. To say that 134 is a lock is probably an understatement, barring some new flamethrower or something he's going to come out with to try and save the day. I'm not really sure what the issue is. Today, massive problems on trading desks with Tesla options. So there's an underlying issue here, and the third largest shareholder actually called for his resignation today. I'm going to reiterate this. Names like Coin can continue to trickle down in time, just like they did for us in 2002, continue to trickle down while value stocks go higher and the indexes stay flat or down. Certain sectors held up very well. Industrial space. This is one that we have in the trading room or trading community. And we did okay on a portion of it. In an abundance of caution with what we were going into, I felt it was best to maybe reduce the exposure to the entire equity markets. These gap ups are great, like we had on CPI. The gap downs are a huge red flag to me, at least in the short term. But there is something that's happening that's starting to say that, okay, we might be okay in a couple sectors here. But if you take a look at this held in perfectly. If you don't follow along, there is a link in description and you can get the newsletter with updates and timely information. So if you're looking right in here, you're holding perfectly. If we look into the sector, you can actually see that the sector had buying on the gap down. So very few sectors closed over their opening price. A matter of fact, I only found two, right to the doji and then hold, right? But look, you have industrials that held, you have biotech that held. We held our line right in here, and there's more. Here's our death cross, and you may want to remember this. When you have a death cross, your resistance becomes the 200-day moving average. And you can see that pretty clearly, that the 200-day moving average did in fact become resistance. But there's more to this. The inverse is also true. So in our case, if we drill into this, we can actually see that we're getting a golden cross right in here, right against our wedge line. So this held up very nicely. You opened on the gap down and then you rallied on the day. One way to participate in this is the 3X Bull Fund, and you can see exactly how that's doing and how it did. So you're kind of wedged in here, but every time we're getting to this level, it's becoming a buying opportunity, and this should be on your radar. The reason I'm getting this specific is your comments. about wanting to learn more about the sectors and the indexes and how it's all interconnected in the macro. So if you have more comments on how these videos could be better or things that you would like to see, please comment below. I do read them all. I do respond to them all. Now, this is really fascinating to me. This is the Dow Industrial Average. See where your death cross is? See how you were using this as rejection over and over again? And the way that it works is it's rejection until it's not. Right? So right here. But what are we having? We're having a golden cross setting up here. Now, of course, we have to hold in here, but what happens with these is that flips to support. In other words, we've now broken, retested, went higher. This should be support now with that golden cross. So that fits in there with the industrials. We don't know if it's going to happen, but the beauty of this is we have a long-legged doji. And as we know, long-legged dojis are signs of uncertainty. And usually the way of the doji, whatever way the doji winds up going, is the way that the trade will go. So it sets us up for a very low risk entry. Now, as I stated earlier, these gaps are very concerning. This doji that we're just kind of hanging out, but we still have an intermediate sell signal when we hit the 55 SMA, which is exactly what we did, simple moving average. So we really need to be cognizant of that and paying attention. Anyone can clearly see that we have broken right here. Again, this index can go down and certain sectors can go up. It just means you're not going to take the index with you. But there are certain sectors here that are showing some resilience. Honeywell, John Deere, Raytheon, Lockheed Martin, Caterpillar, all closed above their opening price today. Now, as you know, we follow along in these videos. They all are pretty much interconnected as we go through the week. And one of the things we've been showing for weeks in the newsletter, as well as in these videos, is the S&P. Are stocks in the S&P above the 50-day moving average. For the past 2 years, this has only happened 4 times that we've had a reading of 89 or higher. So we knew that something was coming. We just didn't know when. We knew there was going to be a pullback. Again, we just did not know when or what the magnitude of that was going to be. What's pertinent about this is today's reading is now a 56. So in other words, we have started to really work off of that level. And that's exactly what we want to see. So we're going to have to watch how we respond in here. Stocks in the S&P above their 200-day moving average. Higher, high. Lower, high. In other words, more stocks are getting above their 200-day moving average, but the index is dropping. Why? Value is outperforming growth. Follow the money. This is the S&P. This is the dollar. This is the 10-year bond. When asked why am I somewhat concerned, I was a little concerned because as the dollar rises, equities drop and people sell bonds. That's not what they did. The dollar went higher. This is an hourly chart, and they actually bought the treasury. Higher yields mean lower equity prices. But that's not what's going on here with the treasury, the 10-year treasury. Look, we're actually dropping and the SPY plummeted today. Now that's a disconnect and that should not be happening. The video was a trade we did today. Most people try and trade these early bars, and sometimes I will too, but on quad witching when we have $4 trillion of notional expiring, I tend to just want to see this play out. Now the volume weighted average price is exactly what it says. It is the volume weighted average price of everything that you see in front of you. So what we were looking for is we want to see one close below the 5-minute moving average. We want to see one close below VWAP on a 5-minute chart. Once we get that and make a lower low, our trade is on. In some cases, you might even wait for the other bar to form and close, and then just execute using up here as a stop. Now, we shorted up here. We also bought puts, and you can see that from the timestamp right here. The reason I'm pointing this out is all you had to do, and I'm doing a video on this for everybody to watch later, is just keep using the tops of these 5-minute bars the whole way down. And you never had to worry about your stop. You never had to rethink your stop. You get your reversal pattern right here. It flips, and that's it. You are closing the majority of the trade. You're at least taking something off to see how it plays itself out later. But something as simplistic as this can save you a lot of time and heartache. You want to build systems and processes. because they're objective. Tesla, same exact kind of trade, but this had way more power behind it. So you have these long bar down, and of course you can do this, but we've all been there before where you just are shorting this and then it just reverses on you. So instead of just guessing, having a process in place where you just watch this moving average, you get below it. Now, the extra benefit of this trade when we shorted it was these two wicks. Once you broke those wicks, you knew you had an issue. So you can short the stock there, obviously, and then on top of the short, adding puts to it, and then just simply using the same exact system that I just mentioned, where you're just using the high of these 5-minute bars. And you're just simply working your stop down until eventually you'll start trimming some in somewhere in this area. You see how I stopped in there. And maybe you're going to hold some to just see how it plays out. But you never really want to stay in past at least a 5-minute close on the VWAP. These are very simple trades that you can implement. You have to realize why VWAP is so important. Institutions are judged every single day on how their trades are going compared to VWAP. In other words, if I'm Elon and I give you 1 million shares to sell, I need to make sure that you are getting out better than the average. If you're not doing better than the average, then I don't need you. And that's really why this line is so important. That's how they're judged. So when you see it break like this, and then you start into a free fall, if you have sell orders that you were supposed to execute here or up here and you didn't, it adds to the selling pressure. The inverse is also true. If it flips and you were supposed to buy, you're going to have a problem. The trading community is currently on waitlist. The link is up here in the top right. Please comment on these videos. I do read every single comment and I do respond to them. It just takes me time, but I do appreciate it. I would like to start doing more educational videos like this, and I'm trying to figure out the best format to do them in. I'm not sure if it's to do them through a trading journal, a smaller account, playing around with a couple different ideas, but your comments would help me on what you would get the most benefit from via education. Everybody, trade to win.